2023 hasn't exactly been a good year for Singapore REITs, with many of them being quite flat or had boom down 18 levels through the floor. So in this video, I'll try to answer the question that everyone is wondering now. Is now a good time to start investing in Singapore REITs? Is the worst already over, or they may still crash some more? As a bonus, I will also show you a very simple way of finding good REITs, plus share a few of my favorite REITs. But before I start, do join my 7,000 members Telegram group to discuss personal finance or ask any questions that you may have. And with that being said, let's first start by finding out why REITs didn't really perform so well in 2023. Hint is related to this man. Without a doubt, this was the fastest rate hike cycle over the past 40 years, where the Fed raised rates fast and furious all the way from 0 all the way to 5.5% now. This caused REITs, a sector that is highly sensitive to interest rates, to start crashing. CapitaLand Ascendas REIT down almost 20% from its peak. Mapletree Logistics Trust down 27%. CapitaLand Integrated Commercial Trust down almost 30%. These are the top REITs in Singapore, and even they've already fallen by so much. I won't even dare to look at some of the worst performing REITs because they are much worse off. But let's look at them anyway. Easy World REIT down 65%, Prime US REIT down 80%, and worst of them all, Manulife US REIT down 90%. But if you look at the REIT charts, the good one I mean, not the bad ones, you will notice that there's been a sharp rebound at the end of October. This was caused by the drop in long-term US Treasury bonds as inflation rate is steadily declining, job market being resilient, and the Fed saying that they might start cutting rates in 2024. Basically, the REITs are now pricing in the expectation that things are about to get better soon. So, it's now a good time to invest into REITs. You know, buy at the bottom and quite big when it goes up. There are a few things that we can look at, but let's talk about the interest rates first. The market expects the Fed to start cutting rates by May 2024. Same for Goldman Sachs and Vanguard, who also believes that the rate cut will happen around the middle of the year. Interestingly, this coincides with historical data, where in the past 30 years, the rate has on average stayed at the peak rate for 11 months before the Fed started cutting rates. So the last rate hike was in July 2023, so we could be seeing the first rate cut around the middle of this year. However, while there may be a rate cut soon, both the Fed and the market predict that the rate cut will only be minimal and might at most reach around 4 to 4.5% by the end of next year. This means interest rates will stay high for longer unless something bad happens. What? Some of you might have recalled seeing this chart a while back, where it shows that the market crashes whenever there's a Fed pivot. However, you have to understand something. A crash doesn't happen when the Fed pivots, but rather the Fed usually pivots when the conditions in the market are bad. In this case, the economy could enter into a recession in 2024. There are a few signs that may point to this happening. 1. The 10-year minus 3-year yield curve is still highly inverted. And according to historical data, recessions would usually happen whenever the yield curve has inverted and uninverts itself. Second, despite all the record numbers from Black Friday sales, the reality is that the asset savings that households have accumulated during the pandemic period has already been used up, while we are starting to see some declines in monthly retail sales. Meanwhile, credit card debt in the US has been climbing up. Same for delinquency rates on credit card loans, which has also gone up. On the job market, US firms are now slowing down hiring, while the US has added less jobs in the recent few months. All of this data suggests that we may start to see the economy slow down going forward, which may possibly, perhaps, maybe lead to a recession. But don't get me wrong, this is not to say a recession will confirm plus chop happen, and the market will definitely crash, According to analysts, S&P 500 companies are expected to report a higher earnings growth next year, and because of that, we may see the bull market continue in 2024. And this is also the reason why it is so hard to predict the market, because there are so many moving parts, all of which may affect the eventual outcome. That's why it's also useful to take into account how the REIT sector is doing now. Quick pause. Did you know that Momo Singapore provides you with an easy way to search for and research dividend stocks? To do that, you can open up the Momo Singapore app, head to Markets, go to the Singapore tab, scroll down till you see the featured list. Tap on it and you will be able to see a whole list of dividend stocks that you can invest in. After that, you can tap on Filter, then add in your criteria to filter the Singapore stocks that you are interested in. To do further research, you can tap on the stock that you are interested, go to the Company tab, and here you will see some useful data. such as the company's latest earnings result, revenue breakdown, key financial indicators, as well as a quick financial overview of the company. All of which may help you make better decisions when deciding whether this is a good company to invest in or not. Right now, Momo Singapore is offering some very generous promotions. You'll first get to enjoy a 6.8% per annum guaranteed returns for up to 31 days on your first $60,000 invested with Momo Cash Plus. Besides that, they are also offering the new Fullerton SGD T+0 fund, where it's the first retail SGD cash fund that has enhanced intraday liquidity. Please note that Momo Cash Plus is an investment product. This is not comparable and is different from savings deposits. Principal is not guaranteed, and up to 31 days of 6.8% per annum is guaranteed only during promotional period. Investment in any capital market products involves risk and the risk to lose principal. On top of that, you'll be able to unlock up to 4 stock bundles of the top 5 traded US stocks worth $70 each and an Apple share worth $260, plus up to $20 cash coupon exclusive rewards when you sign up using my link. So there is $900 worth of welcome rewards in total. Holding period and buy trades applies. Besides the welcome promo, if you complete 3 successful buy trades via RSP with a minimum of $100 per trade, you will also receive $6 worth of cash coupons. This is applicable to both new and existing users. So if you are interested in taking your investments to the next level, do try out Momo Singapore. For more details of the promotions, please refer to the link promotion page in the description below. And with that being said, let's get back to the video. According to this chart by SGS, the REIT price index to book level is at a historical low, while offering a rather attractive forward dividend yield of around 6%. At the same time, we can also see most of the property segments in Singapore have been doing rather well. For example, in office space, the core CBD Grade A rents have gone up by 1.7% year over year. Same for retail, residential, and industrials, which have seen increases in rents. And according to this chart by Capital Integrated Commercial Trust, there will be a limited supply of retail space being built over the next 3 years. Same for office space, where the new supply will be lower going forward. And because demand is higher than supply, occupancy rates will remain high and landlords are in control of rental prices. For example, for CICT, the portfolio has an amazing 97.3% occupancy rate. However, on the US side, things haven't been doing so well. Because of the whole work from home trend, more workers are now working from home. This resulted in high supply and low demand for office space, and vacancy rates have increased in many states. That also explains why many US office REITs like prime US REITs haven't been doing so well. As for the China and Hong Kong property market, well, let's just say that they will need a few more years to recover. Which brings us back to the question, if I wanted to invest into Singapore REITs, would now be a good time to do so? Personally, I think that while REITs are now cheap, the worst may not be over for them yet. If you check their debt maturity profile, all of them have debts that will mature within the next few years. For example, for CICT, 28% of the debts will mature in 2024 and 2025. Same for CapitaLand, Ascendas REITs, and so on. This means that the cost of debt and gearing ratio will go up. If this is not properly managed, the REITs may be forced to cut their dividend payouts, and that was what happened to Keppel DC REITs. So, probably a better strategy would not be to all in now, but instead slowly buy into them over an extended period of time to take advantage of any future drops. As to which REIT you could go for, here are my 3 simple criteria for choosing good REITs. 1. The dividend per unit must go up over time. The whole reason you would want to invest in dividend stocks is because you want to receive dividends ma. And the dividend needs to go up over time in order to hedge against inflation. For example, here's a beautiful chart by Parkway Life showing that their dividend payouts have increased steady from PP over the years. Second, the dividend yield must also be within a normal range. If it is too low, then it's not worth looking at, since we can easily earn 3 to 4% from SSB and T-bills now. But if it's too high, then it means that something is wrong with the REITs. Right now, a reasonable dividend yield for REITs would be somewhere between 3 to 7% range. Lastly, the stock should go up over time, or at least don't go down lah. If you see this kind of chart or this kind, stay far away from them, because cheap can go even cheaper. So here are some of my favorite REITs which you can check out. not financial advice, of course. CapitaLand Integrated Commercial Trust, which is now giving around 4.5% yield. This is Singapore's largest REIT, and their portfolio consists of retail, office, and integrated development properties that's mainly located in Singapore. The second REIT is CapitaLand Ascendas REIT, which is currently giving over 5% yield. This REIT is Singapore's largest business and industrial REIT and holds properties in Singapore, US, Australia, and UK. Next, Mapletree Industrial Trust, which is now giving about 4.8% yield. As the name suggests, this REIT hosts industrial properties and hosts a mix of data centers, high-tech buildings, business park buildings, and so on. Last but not least, Mapletree Logistics Trust, which is also giving a 5.6% yield. This REIT focuses on logistics properties across a diversified sector. As e-commerce and shipping remains an important industry, this REIT will be a very resilient REIT to have. So that was a quick update on what's happening to Singapore REITs now. But do comment down below and let me know. Will you be buying REITs now? And if so, which REITs will you be looking at? Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.